Trump's new big beautiful bill, it's here. And it could be one of the most important financial opportunities that we've seen in years. And we're definitely gonna know by July 4th because that's the deadline. Listen up, if you're an investor, an entrepreneur, a W-2er, you need to know what's in this bill. And it might be Trump's biggest legislation in his entire term. This bill is complicated. It includes a lot. So what I'm gonna do here is I'm gonna reduce it down to the 5 most important parts of the bill that you need to know. Let's go. I'm Kris Krohn, and I have helped thousands of people use real estate as a wealth building tool for financial freedom. And honestly, I don't really care if you vote red or blue. What I care about is helping you grow your green. I've never tried to get super political in my videos, but here's the truth. Policy impacts economy, your personal economy, and that economic policy impacts your investments. That means that I've got an obligation to keep you in the know of what's going on. And Trump's new bill, listen, it's packed with tax breaks, investment incentives, and tools that could either fast track your wealth or it could honestly leave you behind. If you don't understand them, we're gonna get you caught up right now because today I'm gonna break down the 5 most important updates to this brand new bill and what they mean for beginner investors and experts. And hey, before we get rolling, please hit that like and that subscribe button. It helps me out. It tells the algorithm that this information is gonna be useful for other people as well. Thank you. Major point number 1, permanent tax cuts. Let's start with the basics. This bill seeks to make permanent some of the major tax cuts. It does this by extending the 2017 Tax Cuts and Jobs Act, which means that a bunch of temporary tax breaks are now becoming permanent. First, the standard deduction stays extended. This is the amount of money that you can earn each year that's completely tax-free. Before 2017, a married couple could only deduct $13,000. But after the expansion, it jumped to $27,000. And now it's here to stay for good. That means that if you're just starting out and you're earning under that amount of money, that you don't owe any federal income tax on that at all. And for everyone else, it's gonna lower the amount of taxes that you pay. Across the board, tax rate reductions are staying locked in. So the percentage that you pay at each income level is lower than it used to be. This benefits both individuals and small business owners, especially people earning 6 figures or growing side income through the game of real estate like I teach all day long. It means more of your money stays with you instead of going to Uncle Sam. And then we have to talk about the estate tax exemption, which is now doubled potentially permanently if this passes. Now, what's an estate tax? It's the tax that your heirs could owe when you pass away and you leave them your assets. This bill locks in the exemption at nearly $15 million per individual, now $30 million per married couple. So if you're building a real estate empire with me or on your own, your kids can inherit it without getting crushed by taxes or needing to sell off properties to pay those taxes. This is a huge win for generational wealth. And finally, the child tax credit gets increased from $2,000 to $2,200. This means that parents get a larger credit, AKA a direct reduction on their tax bill for each dependent child. If you've got kids and you're investing to build a better future for them, this puts money back into your hands and it helps you make that happen. Bottom line to all of this, these changes give you more control over your income today and they make it easier for you to pass on your wealth tomorrow. So whether you're a house hacker, like me buying their versed house once upon a time, or you're buying a duplex, or you're starting to build a portfolio, this creates tax-friendly environment for your long-term planning. Major point number 2 on this bill, no tax on tips and overtime, as well as SALT deduction is being raised. Now listen, this one is for workers, side hustlers, and the gig economy pros. Under this bill, the government says that if you make less than $150,000 a year, you're not gonna pay federal taxes on your tip income up to $25,000 or your overtime up to $12,500. Let's break that down further. If you're a server, bartender, rideshare driver, or a hairstylist, tips are a huge part of your income. Same with hourly workers pulling overtime. Before this bill, that extra money was taxed, just like normal wages. But now it's tax-free, meaning that you get to keep more of it. Guys, that's real instant cash flow savings. Now, the reason why this matters for investors, especially if you're a beginner like me and you're just starting out, every dollar you earn matters. You want that in your pocket so that when you save up your pennies and you can put it towards your first investment, you've got more of those savings actually working for you. Now, if you've already saved up for your first down payment on a property, this could definitely be the difference between getting in the game or staying stuck. For my audience, like if you're a subscriber, many of you are trying to hustle your way out of the middle class or the lower class. This tax-free income, it's fuel because it helps you save faster, invest sooner, and qualify for loans a lot more easily. Now let's talk SALT, right? The state and local tax deduction. Before 2017, people could deduct all their state and local taxes that they paid, like property taxes, from their federal income tax return. Then a cap was introduced, like a $10,000 max. That hurt people in high tax states like California or New York. What this bill does is it raises the cap to $40,000 for 5 years. So for example, if you own property in a high tax state, this could save you thousands of dollars, literally. And if you're a landlord passing on tax benefits through smart LLC structuring, this also gives you room to breathe and expand a little bit more easily. Hey, sorry to pause the video, but this is too important not to share. What I'm about to tell you could literally change your financial future. So hang with me for just a second because you'll want to hear this. If you're working 40, 50, 60 hours a week or more, and you're chasing success, and you're still feeling like it's not enough, maybe it's time for a different strategy. Me and my team are offering free financial game plan calls to help you get a break from the grind, stop wasting time on single-digit returns, and start building real passive income through smart real estate investing. I'm basically gonna put myself in your shoes and say, what would I do if I were you to get where you wanna go quicker so you can also have more time to live the life that you feel called to. Click the link below, book your free call today because I want you to live wealthy and live balanced. All right, the third major part of this bill is bigger small business deductions plus 1-year write-offs. Let's talk about one of the biggest tax breaks in the entire bill, the one that most people don't even know that they qualify for. It's called the Qualified Business Income Deduction, or QBI for short. This lets small business owners deduct a portion of their profits before they even pay taxes on it. And this bill bumps that deduction from 20% to 23%. Let's break down why that's important. Let's say you're a real estate investor on the side, or you're a hustler and you make $100,000 in profit. Well, with this new 23% QBI deduction, the IRS only taxes you on $77,000. That's $23,000 that's completely tax-free, and that's just year one. So if you hang with me and we're making a lot more than that, then obviously the savings are gonna grow from there. Now you might be asking, what counts as a qualified business income? Well, if you own a small business, or you have an LLC, or you earn money through rentals, flips, Airbnbs, wholesaling, you might already qualify. Basically, if you're self-employed or you're earning income outside of a W-2 job, there's a good chance that you can take this deduction. Now, you don't have to have a storefront. You don't need employees. You just need a business that's making money. Now, you are going to see exceptions. Some types of businesses don't qualify for QBI deduction, specifically what the IRS calls specified service trades or businesses. These are businesses where the value comes mainly from your personal skill or your reputation. So we're talking about doctors, lawyers, consultants, financial advisors, actors, athletes. If you're getting paid for who you are and what you personally do, but not for selling products or managing properties, you might get phased out of the deduction, especially if your income is really high. However, it does get even better. You see, this bill also allows you to write off the full cost of equipment, renovations, or construction in the year that you buy or you build it. That's called 100% expensing, and it's great for business owners because before you're gonna have to break up your deduction over 5 years and they'd let you just take a little piece of it at a time. But now, permanent, it's all up front. So let's just say, for example, you spend $60,000 rehabbing a fourplex. Instead of waiting half a decade to write it off, you get to claim it all in that year. That drops your taxable income right now, which means more cash flow, more freedom, and faster reinvestment. Bottom line, if you're running your real estate portfolio like a business, and you should be, then this bill just made it even more profitable. The fourth major part of this bill is expanded opportunity zones and tax-free investing for kids, which is big because my kids paper trade. My son Daniel just came to me and he's like, Dad, dude, since I started, in the last 90 days, my investments are up 11% on my picks. When can I start using my real money? Well, check this out. This is big, first of all, for long-term investors. And I typically tend to be a long-term investor because I'm gonna buy a single family home and then I'm gonna hold it for generally 5, 6, or 7 years. And then when I sell it, it's because my original down payment and all of my profit give me the ability to now buy 2 homes. So one turned into 2, that's gonna double my ROI. And maybe 5 years later, I sell those 2 homes and I turn them over to 4. And if I do this for 20 years, like literally if you start with a single rental like I did, 20 years later, you can build up a multi-million-dollar real estate portfolio. That's the kind of long-term that I'm talking about here. Opportunity zones, for example, these are areas where the government wants to see those neighborhoods or parts of town revitalized. They're often rural, they're often low-income neighborhoods, they don't look good. And if you'll invest in these zones, you get major, and I mean major tax advantages. For example, you can defer capital gains from other investments. You can reduce the taxes that you owe on other stuff if you hold the property for a few years, or you can eliminate your tax bill entirely if you hold it for 10 plus years. This bill expands those zones, bringing $100 billion in funding to new locations. That means more chances to buy in these areas while prices are still very, very low. And more motivation for developers and city planners to improve those areas in town. Now listen, if you're syndicating deals or you're looking for your next big project, keep an eye on these new zones because that's where momentum and money is heading. And here's something brand new. Kids under the age of 18 can now invest up to $1,000 a year tax-free into the stock market or a business account. That money can later be withdrawn tax-free for things like college, starting a business, or buying a home. Now, the reason why this matters is that if you're a parent, this is a chance to give your kids a head start. I don't mean give them $1,000, help them earn it, but then show them how to invest it. Teach them to invest early. Set them up with like a Roth account where you can get them thinking about ownership and equity before they even graduate high school. My son Daniel, I talked about earlier, he's 14 years old, and my daughter's 15 and she does henna. And between Daniel's bee business and Livia's henna and cake business, when I look at all of my kids, they're super entrepreneurial. And they'll make money through these little gigs and side hustles, but then they take that money and they're like, Dad, it's just sitting in my bank account. And they know that Dad only believes in real estate. And they're like, it's not enough to put into real estate. I'm like, well, that's true. Like you got a few $1,000s or $10,000 in your bank account. You're not gonna be out of the house for a few years. Well, this bill makes it possible for them to invest up to $1,000 a year completely tax-free. It's an incentive for them and helps them get that start. And by the way, if you're worried about your kids' financial education, I keep my content here pretty family friendly. So this is a great way for you to actually educate your children. I try to keep it relatively basic on some of my accounts so that they can grow financially. I'm doing that for my kids, but I'm doing that for kids all over the nation. In fact, from 5 years ago, I got a bunch of teenagers that are now in their early 20s that are starting businesses or that bought real estate and they've made things happen. So that would be a different reason to subscribe. And you know what? Get your kids hooked on education content like this because it's an opportunity for them to get that financial education. But let's finish with a dose of realism. You see, to fund all these tax cuts, the money has to come from somewhere. And right now they're looking at cutting federal programs like Medicaid and SNAP to be able to fund it, also known as food stamps. I think this kind of sucks a little bit because there are some people out there that rely on those food stamps. And then my parents in their old age, when I'm not paying for all of their stuff, they rely on Medicaid. So this is where it's about to get real, and so is the criticism. What this part of the bill does is it adds more frequent eligibility checks, new work requirements, and start shifting some of the financial burden back onto the states. And what that's gonna do is it's gonna create tension and potentially impact lower income tenants, especially in Class C and Class D properties where government programs often help subsidize that rent. In other words, this administration is saying, we want to shrink the government, we want to push these responsibilities back onto the state. We feel that the states are better equipped to know what their people need, and we'll let them run it at that level. So yeah, people are definitely calling Trump out for this because back in 2016, back again in 2020, Trump promised, for example, not to cut Medicaid. He said it would be left alone, but critics are saying that this new bill goes against that promise, especially with the addition of work requirements and reduced federal support for certain state Medicaid programs. Some conservative voters feel blindsided by this, right? They're arguing that these reforms were meant to reduce fraud or make the system more sustainable. Either way, it's become one of the most controversial parts of the bill. And on top of that, the bill raises the national debt ceiling by $5 trillion. That means that the government can borrow more money. And while some hope that economic growth will balance it all out, others worry that this could increase inflation. Let me say this again, inflation could raise property values, it could raise rents. But higher debt and program cuts could also lead to increased tenant turnover or tighter housing subsidies or more volatility in certain markets. So this is where strategy matters. It's where you gotta focus on assets that produce consistent cash flow, and you gotta stick to stable markets. And ultimately, you need to monitor policy changes so that you never get caught off guard. Personally, I'm worried about raising the debt ceiling because right now, what I've seen a lot in this administration is Trump is trying to figure out how we can do tariffs and all these things to basically bring our debts down. And the last thing we need to do is raise them. And so I'm not exactly sure what the strategy is on that. Now, just because they're raising the debt ceiling by $5 trillion doesn't mean that they have to spend it. But let's just look at stupid human nature. It's called Parkinson's Law. It basically means that if you make $100,000 a year, that's what this is right here, you're going to spend plus or minus 10% of it. So if we raise that debt ceiling, are we just going to increase spending? And if this administration doesn't, the next one's just gonna probably do it anyway. So it's definitely concerning. All right, so what do we make of all of this, right? Trump's new bill, it's not perfect. It's got real benefits, it's got real trade-offs. But if you're an investor, especially someone new to the game, this is the kind of policy that creates openings for you, right? Bigger tax deductions, more take-home income, faster write-offs, new investor tools for your kids, and long-term wealth strategies backed right into the tax code. But let me also be clear, like none of this really helps you if you don't know how to use it. And that's the problem with most people. The window might close fast on taking advantage of this, right? Congress is trying to push this bill through by July 4th, which means we could be just days away from a whole new tax landscape. And if it passes, the people who are paying attention will be able to make smart moves right away. Everyone else, well, they get to find out after the fact, and often it's too late to take full advantage. Most people are just gonna scroll past this. But you didn't, which means you're now way more informed. Listen, they'll keep doing what they've always done. Paying full taxes, these other people are gonna rely on their W-2 income, they're gonna hope that their 401k gets them to retirement someday. But listen carefully, that's not freedom. That's the trap of the paper millionaire. Decent income, decent home, no time, no real financial options. You don't have to live like that. This bill, if it becomes law, could literally be a chance for you to shift into a better vehicle. And it starts with a better mindset, one that builds passive income, creates generational wealth, and gives you the best life back that you possibly can have. But you're gonna have to act while this opportunity is still right here on the table. Consider entrepreneurship. For sure, get into the game of real estate investing. In fact, across all administrations for the last 100 years, one thing truly remains constant. Be an investor and get in the game. As a millionaire minimalist, what I tell people to do is be smart with your money. Don't do Parkinson's Law. Save more than you earn, but then don't stick it in a 401k and hope that 40 years later it's gonna be enough money. You've gotta invest that wisely into the game of real estate. Why? Because if you're with me, over the last decade, I'm averaging 60% a year on my money. And if you're not with me, the average investor still can get 25% on their money. You're gonna outpace the stock market 27-1 over a 20-year span of time. So get in the game. If you don't know how to get in the game, click my links below right here in the description and let me help you get a free game plan and show you, if I were you and I were in your shoes, what would I be doing right now to financially get ahead? Thanks for watching. See you on the next video.